Howdy, Jacob here. Today I'm going to do an in-depth analysis on one of our dividend yield screen stocks, VOD. We got to a price point that makes it look like a screaming deal, but through further analysis, we'll see whether that's the case or not. Let's remind ourselves of some of the financials before going further into it. So a $23 billion market cap, that enterprise value is not right. We see that they have $20 million on hand with $51 billion in debt. So they do have about 30 billion net debt. So this enterprise value should be closer to the 50 billion range, which is a lot for companies, but this is in the wireless telecommunication services industry, and it seems to be pretty much the AT&T or Verizon of the European of Europe, of the EU, and so um, that was my interpretation when I reviewed its 20F that had 1,100 pages. Oof. Okay, but I mean, from a metric standpoint, nearly everything looks extraordinarily cheap. But based on history, their the reason it looks so cheap is that their terminal or their not terminal, their current price to earnings and price to free cash flow has averaged well under 5. And so I think in my initial assumptions, I did minus 2% with a 7 terminal P and price free cash flow when their historical Ps have been and price free cash flows have been closer to the 3 to 5 range. I'm not sure why that is. It could be because I believe it's an advisory share, um, and the fact that they have a lot of debt. So a lot of times when companies have a lot of debt, their P and price free cash will look a little cheap, but based on a price to instead of market cap, um, if you use enterprise value, it's probably closer to the lines of an 8 to 10 range for a no growth business. Makes a lot more sense. So just something to keep in mind. I know when I was looking at it, it's just weird to see P's and price free cash flows averaging like not 10 for a growth business, because obviously a no growth business should essentially have a 10 price to earnings, price free cash flow if they're terminally expected to have no growth. But um, just keep that in mind when you do look at that and it looks a little weird. Understand that it's due to the enterprise value uh, having a bit more debt on hand than cash, and um, then it looks a bit more normal. Okay, so reminder: 11% dividend yield, which is just paying out 2,600 aggregate on a lot more than that. They're averaging maybe 13 billion, 12 billion, and so this 2.5 is nothing to them. They have been buying back debt, paying down debt pretty darn heavily the last 4 years, so that is fantastic to see. I know when I reviewed AT&T and Verizon, I believe those were my biggest ones of that were similar to this, and where I was just like, don't pay a dividend and just pay down that debt, so I actually feel comfortable owning the stock, and owning the company. If you have so much debt, if they, just it just takes one lender to be like, hey, we need this debt now, and then you're gonna have to sell off assets, and you're gonna be selling for dimes on the dollar, which is definitely not what you want to be doing. And so now let's go over some of the notes that I had for the company. So I said after reviewing it, the dollar cost average method to share repurchases, they've repurchased essentially 100 to 350 million or 100 to 135 million shares every month in the past 2 years. And this is from an older 20F because they haven't sent out the newer one yet. Um, and so this is March 21st and March 23rd, March 2023. In those 2 years, it was very consistently buying back shares. Germany makes up 30% of service revenue and was flat year over year. UK makes up 14% of revenue and actually had an increase of 3.6%. Italy 11%, down 4.2%. Spain is 9% of revenue, declined 6.5%. So essentially, it was pretty much flat. total revenue was down 0.6% year on year. Their operating profit was up year over year due to $9 billion in other income from disposal of their Vodafone Hungary, Vodafone Ghana, and Vantage Towers. The borrowings are down year over year. Like I said, in the last 4 years, they've been consistently paying down that debt, which has been great to see for a company with as much debt as they have. But um, they're they still have a lot of debt. So borrowings are down year over year, and cash position is up year over year, with total borrowings at 66 billion. And like I said, cash is about 20 billion. 16 billion is due within the next year on their debt. 27 billion is due between 1 to 5 years, and then 46 billion is due after 5 years. And so 16 billion due in the next year. They have 20 billion in cash and short-term investments and such, and they produce at least in the 5 year average about 12 billion in free cash flow. So that should be a safe number. 27 billion in the next 5 years should be safe. Again, it's just whether the company, that paying down debt is going to be digging into the investment opportunity that they might have to pass up, or share repurchases when their stock is really stupidly cheap. So just take that in consideration. Yeah, it is great that they're doing that. That's what I want them to do. I don't want them to be having to sell off assets to just fund the business. And so, but again, it is taking away from possible business growth opportunities. At least annual 11 billion in free cash flow the last 3 years. Most of payout is dedicated to debt reduction. This is looking at the last 3 years of free cash flow. We saw that they had at least 11 billion in free cash flow each year, substantial, and then 50+% is going towards debt reduction, with a little bit going to share repurchase, a little bit going to acquisitions, and a little bit going to this dividend. And so I'm assuming that dividend stays the same. I mean, historically, they haven't. The dividend's kind of been all over the place, but for the last 4 years has been pretty consistent. And although the payout's low, I think the company is acknowledging the fact that their debt is very high and they do want to dwindle that down. And so I'm comfortable saying that the dividend stays the same, the payout is very safe, and I think that that portion of my assumptions is reasonable. And then the other assumptions, I'm just widening the margins based on the fact that earnings have been a bit lower in the past than their free cash flow margin. And then really their PE and price free cash flow, like I said, is a bit lower than my initial assumption based on their historical PE and price to free cash flow. And so here we get to a price that is still very close to a buy, to get a 50% return. Again, everyone's perspective is different, why you invest. So don't do anything because I say so. I just want to be helping in conjunction with your own analysis. And we're on the dividend yield screener currently, and I mean, it's 11% dividend yield that is paying out 20 to 25% payout ratio. I think that's a safe dividend, and as long as the company really does focus on debt reduction, I do think that this dividend is very safe and that yield is very attractive. And I think that maybe there are better things to do with this company. I mean, right now you can see we're almost getting a 15% return. So buying back shares at this price may make a lot of sense. But for companies that want to show consistency, I feel like a lot of investors really like dividends. And so I think this has a very substantial dividend, miles above the market, and I think that you could get a decent return holding this for the long term. I don't think it's a sexy stock. I don't think it's going to be growing like crazy, but you don't need sexy stocks to get beautiful returns. So I hope everyone enjoyed the video, learned something, and reviews this in conjunction with their own analysis. Thanks so much, and have a great rest of your day.